Hi guys, it's Arsh Ellahi, and in this session we're going to be looking at what properties should you be looking to buy for investment purposes. So before we do that, I want to say a quick hello to all watchers and subscribers, and if you haven't already done so, please press the subscribe and the notification bell right below. So let's get straight into it. In this session we're going to be looking at what should you be looking at. More importantly, how much money should you be looking to spend on your next investment. So let's start from the very basics. So if you're looking just about to start investing, you may be looking at options such as, should I buy a house? Should I buy a flat? Should I buy commercial? And we're going to be looking at the pros and cons for each. I've got some notes here, so if I do look down, please forgive me. So straight away, with a house, with a flat and with commercial, there comes some different parameters, and we need to kind of understand what these parameters are, so it kind of understands where you're going with this. So majority of the houses in the UK are freehold, and when we talk about freehold, we're talking about properties where you own outright. So or the mortgage company will own outright until you've paid off the debt. Now with leasehold, you won't own the land, but you may own the property. So just to give you an example, you will own a flat in a block of flats, but you won't own the freehold of the building. You'll own the little piece of or the little flat within the whole block, and as a result of that you'll also be paying charges such as ground rent, service charges, and you'll be paying that to the landlord, who is the freeholder. So I just wanted to clarify that from the outset. So the first parameter you should be looking at, is it freehold that you're interested in, or is it leasehold? Now if you're looking to invest and make this one of your first investments, my personal suggestion would be that you don't buy a flat from the outset, because with leaseholds you come across all kinds of mini issues, and obviously once you've taken into consideration the service charge and the ground rent, the cash flow is quite limited, and it's also quite limited as to what you can do with the property. So let's face it, with a one-bedroom flat, there's not a great deal that you can do to that property unless you're buying it massively below market value in order for you to extract your money out of the deal. And we're going to be talking about extracting your money out of the deal in this video as well. So my personal preference is to buy houses which are freehold, and the reason being is that there's no one to kind of answer to, so you don't have to speak to the freeholder. You don't have, the only person that really you have to speak to is almost the lender if you've got lending on the property. And when we're talking about lenders in this, we're talking about mortgage lenders, so it could be like the Lloyds, the Shawbrooks, the Aldermores, etc. So one of the questions that I get asked almost daily: where should I invest? How much should I invest? Now this all comes down to you and your personal preference. Now when we say that, is that you've got to ask some questions of yourself. Why are you investing in property? Is it because you're looking to extract cash flow from it? Is it that you're looking to build a nest egg? What's your parameter? Are you after capital appreciation, or are you looking to generate cash flow? Because they're two completely different things. And just to give you a bit of a scale, and apologies for my scale right now. So we've got a pencil here, and we've got the UK. So anywhere up in the north, you'll see that the cash flow will be high, but the capital appreciation will be low. Now in the south, your capital appreciation will be high, but your cash flow will be low. So you've got to try and understand, and you've got to try and find an area really, and understand what is it that your parameters. If your cash flow is high, don't expect to buy a property in central London expecting it to have capital appreciation and also high cash flow. And the reason being is that the mathematics and the economics of it are quite simple. The higher the purchase price, chances are the higher the mortgage you're going to get. The higher the mortgage you're going to get, the higher your interest payments are going to be. Now, unfortunately, it doesn't always reflect in the rental income as to what you're going to spend on the property. And the reason why I say this is, just imagine that you've just bought a property somewhere close to London for £400,000. Now I'm going to get my calculator out here. On a £400,000 purchase, let's just do this live for you at 75% lending. So let's just imagine that a bank like Lloyds is going to lend you 75% of it. Means that you can have a borrowing on it of around £300,000. If you work on an average interest rate of around between 3 and 4%, it means that your mortgage is going to be around £1,000 a month. But if the rental income on that property is only circa around £1,200 to £1,300 a month, it means that your cash flow is only going to be quite limited. Once you've taken into consideration almost like voids, bad debt, management, once you've taken into consideration mortgage payments and also insurance payments, it's going to break even at best. However, the one thing that you've got to take into consideration, again, is that even though it's not generating cash flow, over a period of time, historically, it will increase in capital appreciation. Now, when we're talking about capital appreciation, we've seen that over the last 20 or 30 years, that properties in London have skyrocketed, they've doubled, they've tripled in price. So if you're not really too concerned about the cash flow, but you're looking as almost like a nest egg for capital appreciation or somewhere where you can park some money and know that that property is going to increase in value, then properties down in the south is a better bet for you. I should put in here a caveat that there's no guarantee that a property is going to increase in value. But working on historic figures and working on the historic data, you have got a good chance that properties down in the south will increase in value far better than properties up in the north. Now, let's have a look at it from the other point of view, from a cash flow point of view. From a cash flow point of view, you could, let's just use the example again, that the property that was £100,000, which means that you've got, if you're working on the basis that you're lending 75%, so if you work on for every £100,000, you're putting in around £25,000 yourself. So just imagine that if you've now got £100,000 in the bank and you're looking to use that to the best of its ability, you could potentially buy, instead of buying one property, which is the equivalent of what it would be down south, you could potentially buy 2 or 3 properties up north or in the Midlands. So the way that I see it is that if you look at it from head to toe, you've got north and you've got south and then you've got your Midlands. The south property, the properties in the south are far more expensive than the properties in the north, and the ones in the Midlands do exactly that. They kind of sit within a mid-region. So a property that is worth £400,000 in the south, chances are it's probably worth circa around £150,000 in the north, and approximately the best part of £250,000 to £300,000 in the Midlands. So that's a rough parameter. It's not a guide, it's just a rough parameter from what I've seen over the last 20 odd years. So if you've got £100,000 cash and you want to buy some properties, you could very easily go up to the north. So you could end up going to places like Stoke-on-Trent. You could start to go to the outer skirts of Manchester. You could start to go up towards Sunderland, Newcastle, and within those regions. And you could start buying properties of, within the region of £100,000 to £150,000. Now, based on the fact that there's a £100,000 purchase with a 25% deposit and 75% lending, then you've got your lender's costs, so you've got your valuation costs, you've got your purchase costs, you've got your stamp duty. So all in all, a £100,000 purchase is going to really cost you out of your own pocket around £30,000. So 25% deposit, 3% stamp duty, some legal costs and some valuation costs. So all in all, that's going to come around £30,000. Now, what is that £30,000 going to bring you? Now, the one thing that I'm going to say to you is that we've got to look at this from 2 points of view. We've got to look at it from what I would consider the ROI, which is the return on investment, or even better, the ROCE, which is the return on capital employed. Now, the reason why I do that is because I like to stress test the money that I have in my bank. So when I'm looking at a property at £100,000, I'm not looking at the £100,000 purchase. I'm looking at the £30,000 that's coming out of my bank, and the question that I'm asking myself is that how hard is that money working for me? Now, bearing in mind that at the moment the interest rate is literally almost at zero. So in order for me to keep that money in the bank, it's actually depleting. So what I want to do is understand, is my money going to be working harder for me going into a property somewhere up north than it would be in the bank? And the answer for that very simply is yes. And just to give you examples here, just imagine that I purchased a property for £100,000, and let's keep it simple. Let's just keep it as a standard single let. Now, at £500 a month, times that by 12, it's going to produce around £6,000 a year gross. Now, when we talk about gross, we talk about without deductions. Now, out of that £500 a month, now if you're buying the property at £100,000, sorry, I'm just making notes here, £100,000, 75% lending, so obviously there's an interest charge for that. So of 75% lending, let's just work on around 3%. So on a £100,000 purchase, the bank's going to lend you £75,000. Now, as a result of that, the mortgage payment for something like that is going to be within the region. Let's just say it's around £190,000. I've just rounded it up there, so £190 a month. So £190 a month. Now, if you're a hands-off investor and you want someone to manage that property for you, you're going to need a letting agent. And they, on average, charge around 10% plus VAT. So 10% of £500 is £50, and then the VAT element of the £50 is another £10. So it's another £60 a month. So straight away, your income is £500. Out of the £500, you're then going to take out the mortgage interest, which is £190. Then you're going to take out the insurance, and you're also going to take out the management. Let's just work on about £100 a month for insurance. So straight away, £500 minus £190 for mortgage interest, minus the £60 for management, minus the £100 for insurance, means that we're going to be left with £150 a month. £150 a month, if you times that by 12, gives us £1,800 per annum. Now, one thing that I tend to do is I have a look at how hard has my £30,000 that I've put into this property now started to work for me. So what I very simply do is that I divide the £1,800, which is the net cash flow per annum, divide that by the capital input, which is the £30,000, and that comes in at 6%. So again, £150 a month, multiply that by 12 months, gives us £150 a month, times that by 12 months, gives us £1,800 per year, per annum. I then divide the £1,800, divide that by the £30,000 capital input, which is the money that I've actually put in from my own bank, and that gives me a return of 6% per annum. So these are the things that you've got to be looking at. Would you be happy with 6%? More importantly, it's going to be producing you £150 a month. And remember, we've not put in any of the calculations in there. We've just put in there for mortgage interest, we've put in there for management, and we've put in there for insurance. You could add in a 10% contingency for voids, bad debt, voids, bad debt, and other bits and pieces, whatever you want it to be. Obviously, the higher the contingency, the less the cash flow. But remember, you're not going to be utilising these contingencies on a monthly basis. So hopefully that's given you a rough indication as to the kind of calculations that you should be looking at when you're looking to invest, and more importantly, where you should be looking to invest. Again, thinking of the north for cash flow, down the south for capital appreciation. One top tip that I'm going to give you when you're investing in property: do not get emotionally involved. And I've seen so many people that want almost like what I would consider the trophy property. The trophy property is that they want that 4-bed detached house which is beautifully landscaped, has got the highest of specs. And I've been to properties like this, and when we look at the figures of they've overspent on the refurb, they've spent money on this property or specifications on this property where they would be living in it themselves. Now, as an investment, it's great to have these trophy properties, but the fact is that you're investing in it so that you can make money back out of it. And if you want to spend money on these properties, it's probably best to spend money on these properties if you're looking to buy, to refurb and flip back onto the open market. Because let's face it, when a tenant moves into that property, you're not going to get the property in the same condition that you offered it them. And with all due respect, we've all got great tenants, but the chances are that that property is going to have some wear and tear. So don't overspec the property. Do not get emotionally attached. remember, we've got to think about this from a spreadsheet point of view, if that's the best way of describing it. Look at it from a spreadsheet point of view, look at it from a business point of view, but more importantly, look at it from a return on capital employed point of view. So there we have it, guys. It's just short video, just giving you a brief introduction as to the kind of properties that you should be looking to invest in. Again, I'm not a big fan of leasehold properties. I'm not a big fan of flats. And the reason being is that it kind of limits my opportunities. I did mention that we're also going to be looking at commercial properties as well. Now, commercial properties are great because, again, with commercials, you've got the freehold, you've got the leasehold. Now, there's pros and cons for commercial properties. One of the pros for commercial properties, and when we talk about commercial properties, we could be talking like a shop on the high street. We could be talking like a big industrial unit. We could be talking like a big commercial unit. Now, the big commercial units, they're great when they're tenanted. They're an absolute nightmare when they're vacant. Now, the reason why I say that is because with a commercial unit, you don't know when your next tenant's coming along. When a tenant vacates, you don't know whether a company is going to come along in the next day, in the next month, in the next 6 months. How many times have you seen commercial buildings or commercial properties been sat there for 6 to 12 months vacant? However, when they do get tenanted, they do generally tend to get let out on long, what is called FRI leases, full repairing and insuring leases. So when they're let, they're phenomenal because you may get a 5, 10, 15 or even 25 plus year lease. So it means that you've got a guaranteed income for that period of time. Issue that I have is that when they become vacant, there's no guarantee that that property is going to be let anytime soon. Whereas a 3-bed terraced house in, let's say, Stoke-on-Trent, if a tenant vacates, providing that they've left it in a semi-decent condition, chances are that you can get another family looking to move in within the space of a month to 2 months, which means that we can kind of calculate that void period. Whereas with commercial, we don't know when something's going to happen, and in the turbulent times that we've got right now, commercial landlords are kind of struggling. So there's just a little tip for you guys. So hopefully that's really helped. As always, if you want to reach out to me, you're more than welcome to. You can find me on Facebook, Instagram, Twitter, LinkedIn, and the phenomenon which is Clubhouse. You can, if you're interested in more free information, you can actually download my podcast. We release a new podcast every Tuesday at 6 a.m. It's called The Property Rebel. So you can find us on Google Podcasts, you can find us on Apple Podcasts, as well as Spotify and Stitcher. So again, go and find us. It's called The Property Rebel, and we release a 15-minute snippet every Tuesday at 6 a.m. Finally, if you haven't already done so, have you downloaded the Property Investor app, which is the UK's first property investment platform, which showcases all kinds of deals all over the country. So whether you're looking for below market value deals, whether you're looking for properties that cash flow heavily, whether you're looking for properties that will appreciate in capital value, and just in line with this video, we've got them all on the Property Investor app. Go to the App Store, type in Property Investor. It will take 2 minutes to register and download, and you'll see all the deals within the palm of your hand within 2 minutes. Or alternatively, you can go to the website propertyinvestораpp.co.uk, and you can enter via that method as well. So guys, on that note, wish you all to be safe, well and happy, and I'll speak to you all very soon. Thank you, and bye-bye.